Good afternoon, this is Sean Golden with Golding & Golding, here to discuss the very basics of how to read a tax treaty and how to analyze it. So essentially what happens is the United States has entered into various bilateral tax treaties with many different countries across the globe, more than 50. When there's a tax treaty in place, what happens is that it can impact the ability of the country or countries, referred to normally as contracting states within the treaties, to tax residents, right? With that said, there's always something called the savings clause. The savings clause, which is brutal for U.S. citizens, because basically what it does is it still allows the U.S. to reach their hand in and tax the U.S. citizen who's living abroad, despite what might be in the tax treaty. With that said, there's still some exceptions to the savings clause, which basically says the savings clause won't apply to these specific sections. But why don't we jump in here for a moment and kind of go through. I generally base these things on the idea of a U.S. person living overseas. So there's many different types of treaties, or tax treaties, kind of a loosey-goosey term that's thrown around. You've got your double taxation agreements, you've got estate tax treaties, you've got foreign account tax compliance for reporting. Those are intergovernmental agreements, IGAs, models 1 and 2, which are a type of treaty. You've got the totalization agreements, which refer to Social Security related, but we're just going to focus on the bilateral double taxation agreements. Whenever you're trying to figure out the tax liability that you may have when you've got foreign income involved, is you should always look into the tax treaty. The tax treaty is a great source. It's not normally the final word, but it's a good way to kind of figure out what's going on, how the country may tax it. Do I need to file a Form 8833 tax treaty position, or am I exempt from that? There's lots of exceptions to the 8833. You don't have to file it for every tax treaty position that you may take. So let's go through some of the very basics, right? These are three main things that impact lots of taxpayers. Let's start with real estate. Real estate income is generally going to be taxable in either country. Now, the way you'll normally see it in a tax treaty is it'll say the contracting states may be able or may tax the income. What's very important is that not all tax treaties are the same. Your eyes will glaze over if you try to read more than one. I say in a lifetime, but in a week, right? It's boring, tedious, dense stuff. But some of them will say other stuff. Some of them will say it shall be taxable. So when it says shall, that's more of a definite than if it says may. And there is some litigation out there, but if it says shall, then you better believe the IRS is going to go forward with the idea that it's going to be taxable. Sometimes it will say something like shall only be taxable, and then it'll identify the contracting state or the other state. That's very important, because when it says something like that, then you know only one of the countries are going to be able to tax the income. That could have a significant impact, especially if there's no tax in that other jurisdiction. Passive income is another big scenario. Passive income sort of works like this when you're dealing with the treaty. You've got your main culprits, you've got your interest, capital gains, dividends, and royalties. Generally what will happen is it'll say something like the jurisdiction that you're in is able to tax you because that's where you live, assuming that you meet the requirements for being taxed in that particular jurisdiction on the passive income. But if that income, let's say a U.S. citizen living overseas, if that income is being generated in the United States, even though Joe lives in the foreign country, the United States can still tax Joe on the dividends, interest, other types of passive income, even though the foreign country did as well, but they're limited to the amount of tax that they can issue. In addition, there's normally foreign tax credits that will impact, limit, and sometimes eliminate having to pay tax in both jurisdictions. It varies because different countries have different tax rates, so it doesn't always apply. The final and the most important one that comes around a lot is pension, right? What happens a lot of times is someone will be, let's say they are a foreign person, in this example, living in the U.S., okay? And they have something that's 401k equivalent, right? An Australian superannuation, a CPF, a EPF in Malaysia, MPF in Hong Kong, any type of UK retirement plans, right? So you've got all these different types of retirement plans, pension plans. In the country of source, it generally is going to receive tax deferred treatment similar to a 401k, right? You throw money in your 401k, it goes up in value. It's not being taxed when you contribute it. It's not being taxed on the growth. When you receive distributions down the line, presumably you're retired or semi-retired, your tax rate has gone down, you're enjoying the benefits of both the growth when it went up and the lower tax rate when you're taking the distributions. The problem is the US doesn't necessarily recognize these foreign pensions, right? So depending on what country you're in, it could have some significance. So let's work from better to not so good, right? When you've got something like the UK's got a great treaty, which basically says, for example, you're a US citizen or a US person, let's just say to keep it simple, you're living in the UK, you're working for a UK employer, that UK employer is contributing to a 401k equivalent in the UK. Guess what? A few other things you have to meet, but for the most part, when you file that US tax return, you can take the same deductions on your US tax return for the contributions made to your foreign pension plan, as long as it's employment borne, right? Up to the amount you could take, let's say for the 401k. So if for whatever reason you had a $250,000 deduction in the UK, you can't carry that over here, you take it up to the point that you can take it here. Moving a little further down the line, you've got like the Australian super. There's still a treaty. There was a treaty with the UK, and then there's a treaty with Australia. So basically with Australia, you're not going to get taxed until the money comes out, right? Until you start receiving the pension. So then that's great, right? Because if you're not receiving the pension, then it's no big deal. But what about the employer contributions? Well, there's no section of the treaty that specifically and unequivocally provides contributions made by an Australian employer on behalf of the U.S. person is going to escape tax so that you get the same benefits here. Now, there is a totalization agreement, superannuation, certain super contributions may fall within that, but it's not as airtight, let's say, as the UK. Then you have other countries where there's no tax treaty, like Singapore. With Singapore, the IRS basically came out and said, hey, the contributions made by the employer, yeah, they may be tax deferred over there, but you're going to pay tax on those contributions. And the growth is taxable too, even if you're not receiving any of it yet, because there's no treaty. So since there's no treaty, it essentially amounts to an investment that's gaining income. It's accrues interest. You get that statement, generally about 3%. Chances are the IRS is going to issue tax on that growth as well, and you probably won't have any foreign tax credits to offset it. If you're out of compliance, you've got issues with reporting, you've got issues with taxes you may not have reported, you may want to consider one of the offshore disclosure programs. There's the voluntary disclosure program if you're willful, or you can't certify under penalty of perjury that you're non-willful. Streamlined programs if you're non-willful, reasonable cause, delinquency procedures. We have lots of free information available on our main website. You can always reach out and schedule a reduced fee initial consultation if you think it's appropriate. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.